There are mornings in the life of a market when the price on the screen is the least important thing about it. This is one of those mornings. Silver sits at $75.84 per ounce as Sunday unfolds, up nearly 3% from the $71 low it struck in the middle of last week, and closed there on Friday as though the worst had passed and the worst had been manageable. But here is what separates the informed observer from the merely attentive one. Closing prices describe where a market has been. They say nothing, absolutely nothing, about what changed while you were asleep. And this weekend, a great deal changed. Not dramatically, not with a clean resolution or a clean collapse. Something murkier than either. Something that makes Monday's open genuinely, structurally unpredictable in a way that deserves a real explanation, rather than the comfortable vagueness that so often passes for analysis. Iran sent a new proposal to the United States over the weekend, delivered through Pakistani mediators, with conversations also conducted in Muscat and Islamabad. The framework has one defining feature. It separates the Strait of Hormuz question entirely from the nuclear question. In plain language, Tehran is saying, stop the active military phase first, reopen the strait, lift the naval blockade, and then, once the bleeding stops, we will discuss enrichment. The White House received it. Senior officials gathered in the Situation Room. Secretary of State Rubio, a man not given to easy flattery of adversaries, described the proposal as looking better than past Iranian offers. And then, in almost the same breath, the administration signaled it was unlikely to accept it in its current form. The president, unnamed officials told CNN, does not love the proposal. He was reportedly unhappy that it contains no provisions addressing Iran's nuclear program. The White House spokesperson offered the phrase that has come to define this administration's negotiating posture. The president holds all the cards and will not be rushed into a bad deal. So that is where silver sits as Monday approaches. A live diplomatic development is on the table. The most powerful nation on earth has looked at it and appears cool. Oil markets, which had already priced in a degree of hope on Friday when the proposal news began circulating, do not yet know whether they priced in something real or something that will be formally closed before American markets open. Crude oil fell to around $100.69 per barrel on Sunday, down more than 1% from the previous session, a number that matters enormously for what happens next, because oil, in this particular market environment, is not just an energy commodity, it is the master variable. Every other price in this story, including silver's, is a function of where oil goes first. Trading economics. To understand why, you have to understand what the Strait of Hormuz actually is, not as a phrase in a geopolitical headline, but as a physical reality with arithmetic consequences. It is a strip of water 21 miles wide at its narrowest point, sitting between Iran and the Arabian Peninsula, connecting the Persian Gulf to the open ocean. Before this conflict began, 1/5 of the world's seaborne oil and liquefied natural gas moved through that passage every single day. The International Energy Agency has described the resulting disruption as the largest energy supply shock on record, larger than the 1973 Arab oil embargo, larger than the Gulf War. Oil prices have surged nearly 60% since the war began on February 28th, with the closure of the strait disrupting approximately 1/5 of global oil flows. That is not a statistic to be absorbed and moved past. That is the central economic fact of this moment, and silver is downstream of every consequence it produces. Trading economics. Here is the chain, stated plainly. Elevated oil keeps inflation above 3%. Inflation above 3% gives the Federal Reserve no justification to cut interest rates. The Fed holds rates at 3.75%. High rates make Treasury bonds attractive relative to silver, which pays nothing. Investors choose the yield. The dollar remains firm because high rates attract global capital. A firm dollar makes silver more expensive for international buyers. And silver stays pinned, not because of any flaw in its fundamentals, not because the underlying case for owning it has weakened, but because the financial architecture surrounding it is constructed, brick by brick, from the consequences of a 21-mile body of water remaining closed. That is the mechanism. That is the chain. And every link connects back to the same geographic bottleneck. What makes Friday's move so important to understand before Monday arrives is this. Silver climbed above $76 an ounce on Friday, extending gains supported by a decline in oil prices and U.S. dollar depreciation, following Pakistan's confirmation that Iran had sent an updated peace proposal. The market did not wait for an outcome. It priced in the possibility that one might exist. Oil softened. The dollar weakened partly because Japan intervened in currency markets, triggering a sharp rally in the yen. Silver rose 3% in a single session on news that has not been accepted, on a framework that Washington appears cool toward, on a ceasefire that the administration itself describes as having terminated hostilities but has done nothing to reopen the strait. The market moved on a possibility, and going into Monday, that possibility is still exactly what it was on Friday. A possibility, unresolved, contested, alive but not confirmed. That is the specific nature of this uncertainty. Not randomness, not chaos. A live diplomatic development suspended between credibility and rejection, with silver's direction entirely dependent on which way it falls. Trading economics. Before we go deeper into what this proposal actually says, what Washington is actually calculating, and what the physical silver market is screaming underneath all of this paper market noise, I want to ask you something directly, because the people watching this are not abstractions. They are holders of physical silver, of ETF shares, of mining stocks. They bought at various prices, at various moments of conviction, and they are now watching $75.84 on a Sunday morning and trying to decide whether patience is wisdom or whether it is stubbornness dressed up in the language of long-term thinking. If you are one of those people, if you have skin in this market, hit that subscribe button right now, because what comes next is the part of this analysis that most channels will not give you. Not the scenarios, not the price targets, but the honest answer to the question you are actually asking yourself. Stay with me. Let us talk about what Iran actually proposed, because the details of this framework matter far more than the headline. And the headline, Iran sends new peace proposal, is, in isolation, almost perfectly designed to mislead. The proposal, as reported through multiple sources including Axios and Al Jazeera, has one central structural feature. It decouples the military and economic question from the political and nuclear question. Tehran is not offering to dismantle its enrichment program. It is not offering to surrender the leverage it has built over decades. What it is offering is a sequencing. Cease the active military phase first, negotiate the strait and the blockade, create breathing room, and then address the harder questions in a calmer environment. The logic, from Iran's perspective, is coherent. The Iranian leadership is internally divided. Some factions would accept significant constraints on enrichment, others would not. Getting internal consensus on that question in the middle of an active war, with sanctions compressing the economy, is politically impossible. Separating the strait question from the nuclear question removes the hardest element from the first stage and creates the conditions in which a more durable agreement might eventually become possible. Senior analysts who study Iranian negotiating behavior have described the proposal as reasonable, noting that the strait situation has created a genuine global crisis and that nations across 4 continents are pressing for resolution. The logic of the framework, stop the bleeding before attempting surgery, is one that experienced diplomats across the region appear to find defensible. Mediators in Pakistan, Oman, Egypt, Turkey, and Qatar are actively working to identify language that both sides can accept. That is not nothing. The architecture of a negotiation is present. What is absent is American willingness to engage it on Tehran's sequencing terms. And here is why Washington is hesitant, stated without sentimentality. The nuclear question is the highest stakes element of the entire confrontation. If the United States agrees to lift its naval blockade and end the military phase without extracting nuclear concessions, it surrenders the most powerful source of leverage it possesses for compelling Iran to accept constraints on enrichment. The administration's calculation is strategic. The pressure of a closed strait, compressing Iranian oil revenues, squeezing the economy, and creating domestic political stress inside Iran, is precisely the condition most likely to eventually produce nuclear concessions. Accepting a framework that relieves that pressure before those concessions are made would, in Washington's view, be trading a card for a promise. President Trump reaffirmed that the U.S. would maintain its naval blockade of Iranian ports to intensify economic pressure. The posture is not irrational. It is the classic logic of maximum pressure. Hold everything until the adversary offers everything. The problem, of course, is that maximum pressure cuts in multiple directions. It pressures Iran. It also pressures the global economy. Brent crude was priced at $116 per barrel early Friday morning before falling back as hope about the proposal circulated, a price level that translates directly into inflation, into suppressed consumer spending, into a Federal Reserve that cannot responsibly cut rates no matter how much the growth side of the economy might benefit from relief. Trading economics, fortune. This is the contradiction at the heart of silver's current predicament, and it deserves to be stated with some precision. The conventional wisdom, the rule that has been internalized by a generation of commodity investors, holds that geopolitical conflict drives capital into precious metals. War equals safe haven demand. Chaos equals gold and silver rally. That rule has historical validity. In certain environments, when interest rates are low, when the dollar is already weakening, when central banks are already leaning toward accommodation, it works cleanly. Investors flee uncertainty and land in metal. But we are not in that environment. We are in an environment where the geopolitical crisis is simultaneously producing safe haven demand for precious metals and producing the precise conditions, energy-driven inflation, Fed paralysis, dollar strength, that suppress non-yielding assets like silver. The war is doing two contradictory things to silver at once, and right now, the suppressive force is winning. Hence, $75.84, not $105. Silver remains down 18% since the beginning of the war, as energy supply disruptions have heightened inflation concerns and reinforced expectations that major central banks may keep interest rates elevated for longer or potentially tighten further. That sentence should be read slowly because it contains the entire paradox. The war created the very conditions that are keeping silver below where the physical market says it should be trading. The bullish case for silver does not come from oil being high. It comes from oil eventually falling, because lower oil means lower inflation, means the Fed can cut, which means the dollar softens, which means silver breathes. The counterintuitive truth is that lower oil is better for silver than higher oil, not because of geopolitical sentiment, but because of what oil does to rates. Investors who are waiting for silver to explode higher because of the conflict are waiting for the wrong mechanism. Trading economics. Now look at what silver itself did this past week, because the specific sequence of events tells you something precise about how this market is positioned going into Monday. Early in the week, silver dropped from approximately $77 to a low of $71, a 7% decline in 3 sessions, driven by a Federal Reserve vote that split 8-4, with dissenters pulling in opposite directions, and inflation data that came in above forecast. That vote was read as hawkish. The dollar strengthened, rate cut expectations pushed further out, silver fell. Then the Iran proposal news began circulating on Friday. Oil softened. Japan intervened in currency markets. Silver climbed nearly 3%, closing the week at $75.84. The support level near $72 held, for the third time since this correction began in March. 3 separate tests of the same floor, each time with buyers showing up, each time with the price bouncing. In market terms, a level tested 3 times without breaking carries increasing significance. Not invincibility, significance. And that is the specific positioning going into Monday. Cautious, partial re-entry. Traders who stepped back during the hawkish FOMC read tentatively returned on Friday's diplomatic hope. They hold a 3% gain achieved in a single session on news that is not resolved. They are sitting with positions sized for uncertainty, not conviction. If Monday opens with any signal, that Washington is moving toward rejection, those positions will be unwound quickly, and silver will test $72 to $73 within hours. If Monday opens with even a softening of language from the White House, those same traders add. Silver extends toward $78 to $79. The market is a coiled spring at this specific moment, not randomly, not chaotically, but because the specific information required to determine direction is incomplete and contested as of this Sunday morning. There is a temptation in moments of genuine complexity to reach for a simple conclusion. Markets reward clarity. Analysts who offer it confidently attract attention. And in the silver space in particular, where retail holders tend to be strongly convicted in one direction or another, the pressure to deliver a clean verdict, bullish or bearish, buy or hold or sell, is persistent and real. This analysis will not offer that verdict, not because the picture is unknowable, but because the picture is genuinely dual. Both sides of this market are telling the truth simultaneously. Both forces are real, and both forces are substantial. And understanding how they resolve is worth more than any confident prediction that shortcuts the complexity. On one side sits the physical market, and it is screaming. The Silver Institute has confirmed a 2026 supply shortfall of 46.3 million ounces, a 6th consecutive annual supply deficit. Above-ground stockpiles are being drawn down year after year. China has been importing silver at levels dramatically above the 10-year seasonal average. COMEX delivery coverage has been below 15%, the threshold that signals physical stress, for 6 consecutive months. And the industrial demand picture has not weakened, it has accelerated. Fresh earnings from AI hyperscalers confirmed that $715 billion in capital expenditure has been committed this year by Meta, Alphabet, Microsoft, and Amazon, compared to $375 billion last year, a near doubling of the infrastructure spending that drives inelastic industrial demand for silver in servers, power systems, and cooling architecture. The physical market is not suggesting silver is undervalued. It is insisting on it with the kind of arithmetic persistence that does not care about short-term paper dynamics. JM Bullion, Trading Economics. On the other side sits the paper market, and it has its own kind of arithmetic. High nominal rates, currently 3.75%, against inflation running at approximately 3.3%, produce a real interest rate that is barely positive, perhaps 0.4%. That fraction matters. When real rates were deeply negative in 2020 and 2021, holding silver cost investors almost nothing relative to holding a bond. The bond was losing purchasing power in real terms. Silver was holding it. That is when institutional money floods into metal. When real rates are positive, even marginally, as they are now, bonds are marginally attractive. The opportunity cost of holding silver is small but real. And that small but real cost, multiplied across institutional portfolios worth hundreds of billions of dollars, creates the steady selling pressure that has kept silver pinned in the 70s rather than approaching the 90s. For silver to break meaningfully higher, to challenge $85 or beyond, specific conditions must materialize. Oil needs to fall below $95 and hold there for multiple consecutive sessions, not a single-day dip on diplomatic optimism. The April Consumer Price Index reading, due May 12th, needs to show the first credible sign that energy-driven inflation is beginning to moderate. And the incoming Federal Reserve Chair, Kevin Warsh, whose Senate confirmation vote is expected the week of May 11th, and whose tenure begins May 15th when Jerome Powell's term expires, needs to signal in any public communication that he views the current rate level as appropriate for reassessment given the economic slowdown. He does not need to call for an immediate cut. He needs only to indicate that he watches the growth side of the Fed's mandate with equal attention to the inflation side. Markets believe Warsh leans more accommodative than Powell. If he confirms even a fraction of that perception, rate cut expectations will be repriced forward, and silver will respond before the first formal decision is ever made. For silver to break meaningfully lower, to challenge $67 or below, equally specific conditions would need to materialize. Iran's supreme leader has already dampened prospects for a deal, pledging not to relinquish nuclear or missile capabilities, and indicating that Tehran would retain control of the strait. If that posture hardens into formal rejection, if oil spikes back above $113 and holds there, if the April jobs report due Friday, May 8th comes in above 200,000, showing a labor market completely unaffected by the energy shock, then the case for rate cuts disappears entirely. Some traders have already begun pricing the possibility of a rate increase in 2027. Strong jobs in a high inflation environment is the worst possible configuration for silver's rate cut thesis. And if the $70 support level, which has not yet been tested in this correction, only the $72 level has, breaks on a daily close, that is the signal that the paper market has decisively overpowered the physical floor that has held 3 separate times. The next meaningful support in that scenario sits in the $63 to $67 range, and that is a different conversation entirely. Trading economics. Right now, none of the triggers for either scenario have fully occurred. That is why silver is at $75.84 going into Monday, exactly in the middle, waiting. And the waiting is not passive. It is the market's entirely rational response to incomplete information about a live diplomatic development whose outcome will determine the direction of oil, which will determine the direction of the dollar, which will determine the direction of silver, in that sequence and in that order. So here is the practical guidance, stated without ornament. Sunday night, before you look at silver, look at where Brent crude opens in Asian trading. If it gaps lower by more than $1, moving from the current $107 to $108 range toward $105 or below, the market is extending credit to the Iranian proposal. Silver will likely open the U.S. session above $76 and push towards $78 to $79 intraday. If oil gaps higher, toward $112 or above, the market is pricing rejection. Silver opens below 74 and tests 72 to 73 during the session. If oil opens flat, within 50 cents of Friday's close, You are in the third scenario: high volatility, low direction. A Monday that moves silver several dollars in both directions before closing near where it began. Do not overinterpret intraday moves in that environment. The patient holders come out the same or better. The traders chasing every swing get whipsawed. Watch the dollar index alongside oil. Watch for any statement from the White House before U.S. markets open, specifically for the words considering or studying, which indicate genuine engagement, versus the phrase holds all the cards, which signals maximum pressure posture unchanged. Watch the jobs report Friday. Watch Kevin Warsh. Watch the $72 floor on silver itself. Those 5 signals will tell you, in real time, which force is gaining the upper hand. The resolution, when it comes, will not be gradual. These things rarely are. 2 genuinely powerful forces in direct opposition do not reach equilibrium slowly. They hold the tension, and then one of them breaks, triggered by an event that, in retrospect, everyone will say was obvious, and which in the moment feels entirely unexpected. That is the position silver holders are in right now. Not comfortable, not panicking, informed, watching, understanding precisely what needs to change and what signals will tell you that it is changing. If that kind of analysis, the kind that gives you the framework to read Monday's open in real time, rather than reacting to it after the fact, is what you come here for, then tell me in the comments, what do you think Washington does with Iran's proposal? Do they soften the language, or do they close the door? Because your read on that question is essentially your read on where silver opens Monday morning, and I genuinely want to know where you stand. And remember, this is for education and discussion only, not personal financial advice. I'm sharing a way to think through the history, the market, and the ownership.